So good afternoon, everybody. Welcome to our last Preccelerator event of 2021. It's hard to believe that we've managed to accomplish this whole year, really doing everything virtually. And it looks like 2022 is shaping up to continue in that vein. Although I hope in Q1, we're going to start bringing people back into our Preccelerator offices here for programming, and we'll be able to do a hybrid, meaning we'll have technology where we can have a virtual speaker or a virtual audience, or both, or a combination thereof, and everybody will be able to interact. So stay tuned for that. But without further ado, I want to introduce a new friend of mine, Michael Williams. Michael is a trained attorney. He is he's got a great background. I'm not going to go into his bio in too much depth, but it's not too often you get a professional basketball player, retired, to come on and give us some bits of information that I think are going to be very helpful to all of you who are founders and looking at, how to prepare for those eventualities called taxes. And maybe how to not avoid them, but protect yourself and reduce the tax to make it a more palatable payment, because we all have to pay Uncle Sam. That's what's paying for all these COVID shots. So without further ado, it's my great pleasure to introduce Michael Williams. Michael, I'm going to pin you and you're on.
Great. Thank you for the introduction. Thanks for joining today. I appreciate everyone making the time. So this is me in a nutshell. California licensed attorney. I do a lot of work in M&A and also as a fractional CFO. From an M&A perspective, I only work on the sell side. So what that means, I help entrepreneurs and founders try to maximize their exits from a valuation perspective, and also minimize their exposure from a tax perspective. So these are the three current deals that I'm working on. One's in the SaaS space, one's a professional services company that we're going to talk a lot about today as kind of a case study, and then one is a smaller consumer product acquisition. So because I'm an attorney, I got to start here. These are the disclaimers. This is not legal advice. This is not tax advice. I'm happy to talk with everyone in a one-on-one situation after the call or at some other time, because everyone's tax and business situation is unique. But just know that this is for informational purposes only. Here's today's goals. Number one, the goal for today is to not have me talk for 30 straight minutes. So I would love for attendees to ask questions. You can do so by raising your hand. You can talk and try to get a question in, because again, this is your time, and because everyone's situation is different, everyone's exit is going to be different. If someone tells you that there's a certain way to do an exit, they're probably wrong, because most of these choices need to be bespoke. So the other goals for today, so please ask questions. It's number one goal. Number two is I hope that everyone here will better understand how to prepare the company for a sale, know what planning opportunities exist to mitigate taxes, think about what's going to work for you, and then avoid some of the mistakes that I've seen founders make. Before we talk about tax mitigation, which I know is a big part of this conversation, just the real high-level steps to having a successful exit. The first one on this list is honestly the hardest one for most entrepreneurs to make. Most entrepreneurs and founders are buried in their day-to-day. And while they should be looking at the door from a strategic perspective and some sort of exit, they often get held down in whatever they do on a day-to-day basis. So getting started just to think about what an exit looks like for you, is that in 1 year, 2 years, 5 years, are you trying to get a 100 million X? Are you trying to get a 5 million X? These are very different approaches that you would take to running your business, and very different approaches that you would take to exiting your business. There's a couple other things on here that getting started early is a massive benefit here. The more you plan, the better your exit is going to be. And so that's the pro tip on the bottom. So I have had a client come to me and say, I want to sell my business. And I say, great. I said, when do you want to sell it? He said, 2 weeks. So that's going to be a problem, right? He said, I have to do it in 2 weeks. And obviously that's an impossibility. You give yourself a year, 2 years, 3 years. There's a lot you can do from a tax planning perspective. And there's also a lot you can do from a strategic and operational perspective to build value in your business. When you decide that you want to see that door, these are the types of people externally from your organization that you should be in contact with. The reason these are color coded differently is the ones in green are required. The ones in blue are optional based on your deal size, deal complexity. So obviously the entrepreneur, the most important piece here is in green because they're the one driving the business. The other three that are listed in green, I think, are crucial to a successful exit. So that's just a CPA, an attorney, and a tax advisor. And most of these are going to be coming from firms. There are some excellent solo practitioners. And just so we're clear, your tax advisor is highly likely going to be different than your CPA because those are having a qualified tax advisor, a tax planning advisor, someone who can help you mitigate those taxes is a different skill set than the vast majority of CPAs have. Just real quick rundown about what a successful transaction looks like. Number one, you have to understand what your strategy is. How are you going to exit? How are you going to go to market? How do you position yourself in a market? How do you tell your story, which is really crucial for a lot of startups. A lot of startups that are exiting are unprofitable, but they have a great story to get them to growth, get them to a place they want to be. So developing whatever that strategy is for you and your company at the outset, that should be your first step. Second one is to identify potential buyers. You know, if you have a professional services company, they're probably not going to be bought by a tech startup. If you have a tech startup, they're probably not going to be bought by private equity, a financial institution like that, right? So you have to understand who your potential targets are for an acquirer. Number three, once you have certain companies or funds targeted as an acquisition, you exchange information, you have an understanding of revenues, understanding of headcount, understanding of expected sales, that sort of thing. You negotiate a letter of intent, which explains the business terms of the deal. Once you go on the letter of intent, you conduct due diligence, which essentially is, we call it opening the kimono. So you're essentially showing your buyer, your potential suitor, everything about your business, every contract you've signed, every tax return that you filed, every employment agreement you've agreed to. All those things come to light during due diligence. At the end of diligence, or in concurrently with diligence, you negotiate a purchase agreement, which defines both the legal and the business terms of the ultimate deal. And then hopefully you close the deal and get paid. One of the biggest stats that people around in attendance here should know about is that something like 30% of deals that make it to the LOI phase don't close. So the steps after, if you're lucky enough to get to the LOI phase, understand you still have a 30% likelihood of failure. And deals blow up for a variety of reasons. The diligence phase goes sideways, the market changes, you know, interest rates change, macroeconomic issues. There's 100 different reasons why deals don't go through. So again, planning and planning well and planning early are crucial to a successful exit. I want to talk about a company that currently doing a deal with, and we're supposed to close on the 29th of December. So assuming that we close, it'll be a nice way to end 2021. So this is a highly profitable professional services company, strong growth, you know, single-owned company. The guy's been running it for 15 years. And wants to remain a part of the business, and I will emphasize that he hates paying taxes. And so the reason I wanted to focus on him today is we went through about a dozen potential tax planning strategies for him. He chose 2 of those 12, but the takeaway here is that there are a lot of tax planning strategies. They have to work for the particular entrepreneur that is going to utilize them. If they don't work, in theory, they're not going to work in practice. One of the things that we talk about very early in this process that does have an effect on the tax effect of the sale is the structuring considerations. Are you going to sell your assets? Are you going to sell stock? Are you going to stay on with the company, or you just want to go fishing for the rest of your life? You know, what do you want to do? Do you want to stay with the business? Do you want to be involved in the day-to-day? And also, how much cash do you want up front? How much you care about saving taxes, and how much flexibility you want. So again, you're going to hear me say this over and over again today, is the solution that you decide to, or the path you decide to take needs to work for you. The reason this asset versus stock sale thing is crucial is because stock sales get capital gains tax treatment. Len, can I ask how many people understand the difference between capital gains and ordinary tax rates? Maybe that's a good starting point.
Yeah.
Anyone? Okay. Anyone not know the difference? It's okay if that's the case.
So to restate the question, just so everybody's clear.
Okay, so does everyone understand the difference between ordinary income and capital gains taxes?
Okay.
Great.
I'm seeing nods and not seeing heads in the background, but I think people probably have that. Bennett's going side to side, so maybe that's was that a no, Bennett?
Michael, while you're here, why don't you give us the rundown on what that means?
Appreciate that, Bennett. So we live in a capitalist society because capital has received favorable treatment. So people who make investments receive favorable tax treatment. So when there's a difference between how, if you earn a paycheck and you get a W-2 at the end of the year, you are taxed differently than if you sell a stock, right? And your company is essentially a private stock. So if you have a company that is for sale, you choose one of these 2 ways to sell the business. Now, this is a point of negotiation between buyer and seller. There's a lot of reasons why so the primary reason why a buyer wants an asset sale is they can redepreciate assets which had been previously depreciated. The primary reason why a seller, which is you, wants a stock sale is that when you get your payment, you are paying a lower tax rate at the federal level than you otherwise would have if you did an asset sale. Assets are taxed at ordinary income. A stock sale is taxed at capital gains income. So now this particular deal is on the East Coast. The state in which this deal is occurring is at 7%. In California, California does not make a distinction between ordinary and capital gains tax rates. So in California, if you have a $100 million exit, you will be paying 13.1% of that money, of that sale. You will pay the state of California roughly $13 million on that sale. And that may bump up to 16.8% depending on legislation that is coming down the pipe right now. So we shall see. One thing to note here is if your buyer is insistent on giving you an asset sale and buying the assets that they want to then amortize or depreciate, you can negotiate what's called a gross up. So you can see the difference here between this particular sale, stock versus asset, right? The same facts, it's just the choice of sale. And one of those choices resulted in $12 million more of proceeds in the seller's bank account as compared to because they chose a stock sale rather than an asset sale. In this case, a lot of negotiation occurs between the buyer and seller, and you can have them, you can essentially negotiate to get a piece of that back because they are getting such a big tax benefit. So something at the very early stages, this usually happens in the LOI phase. But it's a way to just show that the difference in this choice can make a drastic change in the taxability of those proceeds.
Can I ask a question, Michael?
Of course.
This is not Liz Mulligan who plays soccer. My daughter was on my Zoom. This is Sue Mulligan. I'm actually an outsourced CFO and have my own firm. In regards to doing an asset sale versus a stock sale, there's the presumed assumption of liability.
Yes.
So in some instances, wouldn't an asset sale be more advantageous if it's a riskier investment? My reason for this question is I've come across some M&A where you don't really know what the true liability of the company is because their accounting has been terrible. And, with just the asset sale, you're not assuming then the risk of their liabilities.
You raise a really good point. So then you'll see this a lot in most deals, a lot of well, it depends on the industry, right? But like a lot of deals now focus on environmental issues, environmental liabilities. So CEQA is a California regulation. You see it a lot. You see it less in the tech world, less environmental impacts. But you're right. When you sell the stock of a company, the buyer is essentially assuming the liability of whatever happened or transpired in the previous life while you were in the company, whereas they don't do that in asset sale. So you are getting the benefit. If you're selling the stock, you get the benefit of the tax break, but you also carry the liability. In a stock sale, you lose out on the liability. You transfer the liability to the new owner. So it's a good question. There's multiple reasons why to do this. This is more of a tax-focused talk, but you raise a good point about the legalities around when a buyer may impose their will on buying assets versus stock. But that's also why it's important if they demand an asset sale that you or your attorney or your investment banker, depending on the size of your deal, negotiate for that gross up so that you can participate in the tax savings that you would have otherwise gotten. It's a good point though.
Okay, thank you.
Great. Any other questions on this slide before we move on? Great. So one of the other choices that you're going to want to make early on is, are you going to stay on? Are you exiting? Do you want to stay on? This comes up in a few different contexts of rollover equity considerations. This is a little bit more of a private equity concept, but it does occur that if you are taking some of your proceeds and putting it into a new company who's buying you out, what are the tax treatments there? Do you have, as part of this, is the payment that you're receiving subject to future performance, right? So that's generally called an earnout. You have to hit certain metrics in order to get the full value or benefit of your sale. And then also, what does your employment agreement look like? How restrictive is it? If you leave, what happens? If you are terminated for cause, what happens? Do you lose out on future benefits? So all that stuff is really important to negotiate. This is really where I want to dial in on how important it is to really take a step back and to think about what you want to get out of your exit. So these are actual things that my seller in this particular transaction that's closing next week is concerned about. So these are in no particular order, but like most founders, he's going to want the highest possible valuation. That's mostly a given. The buyer wants him to roll 20% of his equity into the company. He wanted nothing. We settled around 10%, which he's comfortable with. He wants to save taxes. We're going to mostly talk about that part as part of this particular presentation. He's got some issues in his marriage, which again is somewhat financial, somewhat not financial. He wanted to be able to protect his assets in a certain way from his spouse. He wants to ensure his 2 children's financial security, and he has spending issues. So there was a concern of him receiving a lump sum of cash And so planning around how to give him a 20-year allowance, which I mean by that is like trying to set him up in a tax advantageous vehicle to get him payments every year, so that if he spends like he has historically spent in year 1, he's still going to get that income in year 2 through 20. So those are really important financial considerations. But there's also non-financial considerations. I know we're talking about taxes today, but just a little bit more holistically, how do you approach a sale? In this particular seller's case, his son works in the business. He does not want his son to be tied up in a restrictive non-compete. He wanted to remain with the business for 2 years, and he wanted his employees to receive the generous health, vision, dental, 401k, those employee benefits. It was very important for him that the buyer agreed to maintain those kind of lifestyle aspects of their employment with the company. So those are financial, and for him, the non-financial piece as well. Just again, I think it's very important to always talk about the non-financial. We did this quickly. So basically, we did a carve out, a restricted covenant carve out, which basically said the son can work on this kind of customer, not this kind of customer. The son was okay with that. It worked out for everyone. We got him the 2 years he wanted, and then we got him to with the buyer to agree to maintain that benefit package. And now we're at the point of the presentation where I think everyone wants to hear about how do I actually save money on my exit, right? So there's 6 options we're going to talk about today, right? There's more options that exist out there. These are the more well-known ones in the tax world. 3 of these are less complicated. 3 of them are quite complicated. So it's a little bit of a mixture of the 2. And these are actually the 6 that I talked with this particular seller about, 2 of which he took, 1 of which he didn't qualify for, and 3 of which he did not take, primarily because the state in which he lives did not accept 2 of them, and 1 of which was just too complex for him to understand. He did not want to go with it. So, and this is because everyone's situation is different. This might be a point in the conversation as we go through these to ask some specific questions. Just real quick, high level. And these all have acronyms, right? So the takeaway from this slide is that there's no free lunches, right? Like you can either get a lump sum of cash up front and pay tax, or you can put it into a vehicle where you have less control and pay less tax. You have to hold certain vehicles for a certain period of time. You get really nice tax benefits. You can get access to the cash today and have less tax advantageous treatment. So here's just kind of real high level. If you're looking to give yourself an allowance for the next 20 years, a CREP might work for you, but then you lose control of some of that cash, right? So like, just thinking about this, what makes sense for you? If you're 30, you might want to take the cash now, invest it, start a new venture. If you're 55, if you're 60, if you're 65, you may want something different, right? So these things are going to change throughout your life. And so you have to be somewhat dynamic in your approach, and your tax advisor needs to be dynamic in their approach and understand your particular facts and circumstances to put you in the right vehicle or vehicles. So this is one that we did for the seller here. This is called a charitable remainder unit trust, right? So a lot of entrepreneurs are charitable, and a lot of them make large donations out of the proceeds from their sale. That's one way to accomplish what they want to accomplish. When you do that, you lose complete control of the funds. They go to some very, wonderful organizations that are out there in the nonprofit world, but you lose control. This achieves a very similar goal. However, it creates a lifetime stream of income for the seller. And we're not going to go into detail on this stuff. Some of the stuff is hyper complex. It requires multiple PowerPoint presentations and structurings, all these things. But just to give you a high level overview, what happens is take a piece of your business, you transfer it, you donate it to this trust. The trust then sells its piece of the business in the transaction and then pays the seller an annuity somewhere between 20 and 30 years for the rest, for that period of time. At the end of those 20 or 30 years, depending on the circumstances, whatever's left over gets transferred to a charity of your choice. So at some point in the district, it can be a university, can be the nonprofit of your choice, it can be a charity that you set up. So a lot of people use, if you have young children, let's say you're 40 years old, you have young kids, they're 10 years old apiece, right? You want income for the next 20 years of your life, you can do this, and then when your children turn 30, you can transfer that money to a private foundation that your 30-year-old children then run, and they can be employed by, they can make donations out of, they can receive income themselves. It's a wonderful tax planning tool to ensure that generations of your family can receive income for an extended period of time. Again, if you want immediate cash, this is not the thing for you because you have to wait for 20 years to get the full benefit. Len.
When you put money into a charitable remainder unit trust, when you get that money out, when it's paid out to you, that money is taxable.
That's correct.
As income.
That's right. That's right. So this particular deal, we put about 25% of the proceeds into this, right? So that's going to kick off in this particular transaction. It's about $15 million. There's an 11% assumed rate of return. So every year, the seller is going to receive $1.6 million, which is taxable to him, depending on the nature of the assets within that investment vehicle. But you're right, like there's no free lunches, right? So
right, and the other side of this from the charitable standpoint is because they now own that asset in the trust, they can invest it any way they want, and if they're making 7 to 10% money on that and paying 11% out, it's almost a wash, and that principal can be maintained for at the end of 30 years. Then that full amount would go to the charity.
That's right, exactly. And again, it can be either a traditional nonprofit, a university, whatever your favorite charity is, or you can set one up for yourself, private foundation, and have even further control of that money. So a lot of entrepreneurs like that particular setup because it gives them so much control.
How about using it as putting that principal into a lead trust, and it's kind of just the opposite, right? Now the charitable entity gets the benefit of the annuity for a set amount of time, and then the balance of that trust reverts back to the original owner.
Yeah, there's some, you do also, I prefer the CRUT here just because like this particular version of it, because you also get a charitable donation in the year in which you set this up.
Mm-hmm.
So, and as part of the CARES Act, you can make charitable donations up to 100% of your adjusted gross income. So if the donation is big enough, you can also offset any income you have from the current year. So again, there's, like I said, mentioned before, there's multiple different ways. There's more ways than we're going to talk about today to defer these taxes. These are just the particular ways that either this seller took a look at or that I have done some significant work in.
And Mike, typically in a CRUT, if it's stock that is the asset that's put into the trust, typically they'll sell that stock for cash and then reinvest it in whatever way they want. Is that how? Because they don't really want to have stock in a company. And
they don't, because there's some what's called a UBIT issue, which we don't need to get into because it's too technical. But basically, there's instead of having some of that income be tax deferred or tax free to the CRUT, you could incur some sort of tax that could be very challenging if it's kept in the private stock. But by putting it in public securities, you're in a better situation.
Cool. Any other questions, anyone? Forward on.
Opportunity zone. So this is a new thing, relatively. So this came about in 2017. Some of the tax benefits have gone away out of this. It used to be super lucrative. Now it's still lucrative, but less lucrative. So we're going to do this for the seller here as well. The thing that I like about this is you have time to decide. So in my particular case, we are closing on the 29th. And that we have until June to make a decision about how much money to put into an opportunity zone. So an opportunity zone is traditionally an economically depressed area that the federal and state governments have decided they want to try to build up, right? So there's, I forget how many in California, but there's thousands worldwide, thousands within the US. And a lot of them exist in those economically depressed areas. A lot of them exist in what you would probably not traditionally think of as an economically depressed area. But what happens is if you invest either in an existing opportunity zone fund, or you create your own opportunity zone fund, and then you make investments in either businesses or real estate that are within those defined geographic areas, you defer your tax until the end of 2025. And then if you hold that investment for 10 years or more, the amount of money that you make is then, it comes out tax-free from a capital gain perspective. So just as an example, I sell a company for $1 million. I put all that $1 million into an opportunity zone. I don't pay tax on that $1 million until the end of 2025. Now the benefit there is that I can invest a way higher amount today to start churning more return at a higher level. At the end of 4 years, I will pay the tax. At the end of 10 years, if that $1 million investment, either again in real estate or a business that's located in an opportunity zone, goes to $5 million, that additional $4 million of capital gains is not taxed. And that is like the benefit of doing this, is that second bite of the apple. Now, why would you not do that? It's because your money is going to get tied up for 10 years. You're not mitigating your tax, you're just deferring it, right? So some people don't love that aspect of it. And I should say, if you were to do this in the next 10 days, you would get a reduction in tax, but my guess is that no one's exiting in the next 10 days. So if that's the case, let me know, we'll talk about it. But is somebody have a question?
Yeah, quick question. Did I understand you to say the appreciated value of that firm, the additional $4 million is tax-free?
Yeah, there's a holding period and there's some restrictions that we probably don't have time to go into right now, but that is the general rule, yes.
Okay.
So this is why, locating, this also is, as a startup, if you are located in, again, everyone's situation is different. This is why I had the disclaimer at the beginning. But if your startup is located geographically in an opportunity zone, it's a potential way for you to attract additional investment, because if an investor is rolling their capital gain into your business in that OZ, it's possible they can exit tax-free. Now, again, there's a holding period. There's a lot of things that are challenging, but it's a way to position yourself to attract additional investment. So, but it's a wonderful tax planning tool. It's something that a lot of entrepreneurs since 2017 have taken advantage of. If you're going to invest in an existing qualified opportunity zone, do your homework, because they're like anything else. When there's such an opportunity and it's such a benefit, there's a lot of, for lack of a better word, scams that exist that you should be aware of. Roberto, great question. You can combine a lot of these strategies. So you can combine, so I like talking about, so Roberto Wong just asked the question, can you combine these strategies? The short answer is yes, right? So in this particular transaction that we're kind of walking through as a case study, I like walking sellers through what I call buckets, right? So you can put some money in a You can do some money in the opportunity zone. You can do these other buckets. You can have the boat bucket, right? You want to buy a big boat? That's a bucket, right? And so you kind of just at the beginning of these this planning, you want to again figure out what you want to be doing, and you want to figure out how much liquidity you want up front. Maybe you want to buy a house in Santa Monica, right? Like some of these vehicles are not going to help you with that because you won't be able to access the liquidity that you need in order to satisfy that goal, right? So I like putting earmarking certain amounts of money and then doing the planning in that way. So you would kind of spread everything out and you can achieve multiple goals in that way. But that's a great question. Any other questions about opportunity zones? Great. This is something that I think all startups should be taking a look at. It's called Qualified Small Business Stock, Section 1202 of the tax code. There's some requirements here, and not all startups are going to qualify, but essentially if you are organized as a C Corp, and you are one of the original founders, you can elect qualified small business status. If you hold your stock for at least 5 years and then exit, the capital gain can also be tax-free. So the general limit here is you can get $10 million tax-free capital gain. There are ways to bump that up to more like 50 if you do the planning correctly. Again, that's too complicated to go into right now because this is more of an overview. But there are ways to truly maximize your opportunity from doing this. So again, if you're an LLC, you would not be able to do this unless you elected to be treated as a C Corp for tax purposes. If you're an S corporation, you would have to restructure as a C corporation. The reason to not do this, the last one obviously is supposed to be a little humorous because this is like one of my favorite tax planning strategies. It just takes a long time to come to fruition, right? Like you're in a holding pattern. You have to hold on to the company for quite some period of time. There are some workarounds for that, but I think the length of period of time is often the piece of this that founders don't love, because a lot of them do want to exit sooner rather than later.
So Mike, I think in today's world, though, the actuality is venture funded startups are going to last more than 5 years before they
That's
have
true.
very few exit before that, just because it takes 2 to 3 years just to get it off the ground and launched. And then so that holding period really becomes irrelevant in most cases.
Mm-hmm.
Also, if you're taking venture money, you're going to be a C Corp. That I think it's also
exactly.
So you're going to qualify there. This QSBS is, I think there's some legislation that's looking to affect that, that's in the hopper right now. And I'm not sure if it's going to last, if they're going to keep it or if they're going to get rid of it altogether.
Yeah, it's a really good point. As part of the Build Back Better legislation, they are considering either having this take a haircut or having this go away completely. My hope is that it's neither of those things because it's such a wonderful tax planning tool. You're right in terms of, if you're VC funded, you're likely to be a C Corp. I mean, 99% of the time, right? So, so it's if you are looking at that route as well, hopefully you've done your planning well enough to organize as a C Corp.
Are there other things a founder that is taking venture capital should do or not do in order to make this work?
Yeah, I mean, again, it kind of goes back to every situation is bespoke, right? Every situation is different. But I think essentially, if you are not, if for whatever reason, if you're ready to not organize a C Corp, you should look at doing that immediately. There are, depending on the startup, obviously, if you're looking for VC money, you're more likely than not to be organized as C Corp. There are those that would really benefit from this I've seen that have organized as an LLC instead, for whatever reason that they're doing that. So I would just say, like, cover your basics, organize a C Corp, and ensure that you are receiving original issue stock, because those are the two primary components of this.
So not stock on the secondary market, for instance.
Not stock on the secondary market. There is some case law on that, but it's very fact specific. So you're in a much more secure place if you can, if you're a recipient of the original issue.
Thank you. Roberto has his hand up.
Roberto, go ahead.
Well, what if you're a existing company, and let's say I'm planning an exit in 5 to 10 years, and the current structure is an S corp for the tax advantages for a small biz, and then to take advantage of this method, could I go out and create a new C corp holding company, and then have that C corp, own the existing S corp, and so that we can continue to run for the next 5 years with S corp taxes, and then on the liquidity event, then the holding company is what gets sold.
Maybe. You'd have to do some structuring. It would not entail just applying a holding co, like a hold co. You'd have to,
I'll have to flow some of the profits into the holding company to pay taxes.
That's right. And you also have to be concerned about, so there's you would also have an allocation issue. You'd have an allocation issue on the exit, because you would have two separate entities. If it's just a holdco, you'd have two separate entities that you were selling, and you'd have to have some sort of reasonable basis to value the C corporation at a certain value, right? As opposed to the S, because if the S is where all the action is happening, the buyer is likely going to be, like, let's say you say like this C corp makes about $1. S corp makes $10. They're not going to give you a 50-50 split in the valuation, right? So you'd have to do some sort of allocation.
Now, does it change the picture of that C corp, or let's say I'm intending to go acquire other entities, and then that C corp holding company becomes the acquisition company, and there will be other companies rolled into it?
You should still be okay there if you are, again, subject to all the caveats. You should still be okay there if you were to then try to obtain QSBS treatment for the C corp. So yeah, I mean, I totally get the immediate tax benefits of the S planning, the long-term planning opportunities for this QSBS. Again, depending on your path, depending on your business, depending on a lot of factors. If there's an exit in the near future, this is the preferred path. But again, the immediacy of the S benefits are pretty lucrative as well.
Thank you.
Of course, good question.
All right.
Any other questions about this?
I don't see any.
All right. The next two are a little complicated, so we're going to do just a real quick skim. These are trusts that essentially, just at a very high level, when you're setting up a trust of this kind, think about it not as a trust, but as kind of like a different entity. So like, think about, you set up your company. This is more similar to that than anything else. And what you're doing is you're essentially transferring an asset to this trust, which is holding it separately. In this particular type of trust, again, we're not going to really get into all of the details of this and the next one right now. I would prefer to just talk about the benefit here. By doing this kind of planning, the reason for doing this, if you have a complete rocket ship of a company and you're valued at $5 million today, you think you're going to be valued at $100 million at a time in the future, the reason to do this is this particular tax planning vehicle, this Grad is what it's called, locks in your valuation at that 5, so that when you exit at 100, that appreciation gets essentially removed out of your estate for estate planning purposes. So again, it's going to be too complex. This is like an hour-long conversation by itself. But if you have a high performing startup that is experiencing exponential growth, this is one of the things that you should potentially take a look at to move some of that ownership here because of that fixed valuation at a point in time that's going to be very beneficial for you before it kind of reaches the end of its journey there. Now, one of the tricks here is that you have to remain alive for that period of time. So if you have health issues, this is not for you. But barring that, this is an excellent tax planning vehicle for companies that are on significant rise, significantly on the rise. The last one here that we're going to talk about is called a NING, a Nevada Incomplete Non-Grantor Trust. If you live in California and you have an 8+ figure exit, you should be talking with your tax advisor about a NING. And the reason is a lot of people that I talk to, I said, what's your tax planning strategy? And they're like, I'm moving out of California. I'm like, that's not going to work. And the reason a lot of people do that is they think that if their sale is tomorrow and they move today, that no tax is going to get owed. What they don't realize is that the franchise tax board in California has offices in all 50 states, particularly in Nevada, Texas, Florida, Wyoming, all of these non-tax jurisdictions, where they're essentially chasing people down and saying, this is a sham transaction. You now owe the franchise tax board all this tax, and you had to move out of California. I like California. I've been here for 12 years. I really would prefer to stay here than move to Florida just to get the tax benefit. So the NING allows you to transfer assets to a trust, put that in Nevada, and avoid some or all of those, that 13.1% California tax by moving the assets there. Again, like these other fantastic opportunities we talked about, there is a period in which you will not be able to access that liquidity, and you lose some control. But if your exit's big enough, that 13.1% adds up very quickly. So it's on a $100 million exit, it's $13 million. A lot of people feel that it's worth putting some money in a vehicle like this to get it out of California because they like living in Los Angeles, San Francisco, wherever they want to live, but they don't want to pay the tax. So just key takeaways from this entire talk. You're better off planning early. There's a lot of stuff out there that exists. There's more stuff than we talked about today that exists out there in the market. There's no free lunches. Every time you get a great benefit, you do have to take some responsibility. And assembling a team that can help you with this, a lot of stuff is super complicated. The Grads, the NINGs, anything with an acronym is going to be complicated. Essentially, is how you have to look at that. So assembling a team of expert tax advisors, people who have done that before, people who have done multiple exits, is going to be really beneficial for you to maximize your exit. The reality is that most founders have one successful exit in their career, statistically. So you really need to maximize your successful exit. Hopefully you'll have more in your careers. But if you have one, you can maximize it to the best of your abilities. And part of that is organizing the proper team to help get you there. And then the last thing, again, I know we're talking a lot about taxes today, but we really do have to focus on the non-financial stuff because ultimately that ends up being truly important from a lifestyle perspective, from a relationship perspective. All this stuff really matters. Like the father and son that I'm working with right now are much closer because the father was able to negotiate a non-restrictive non-compete for the son. So that brought them closer. It's not a financial issue, but it's really important. So just keeping your eye on the bigger picture when you're going through the exit is important as well. And that's the whole thing. I know that people had questions. Happy to answer more now. This is my contact information. Like, you want to send me an email, shoot me a text message, give me a call. Happy to talk to somebody for an hour or so. about their specific circumstances, because again, all this stuff's bespoke, and it really matters what your circumstances are. That's gonna determine what works for you.
All right. Michael, thank you very much. Almost a complete hour. And, we're talking about taxes. So, but I will say I'm fairly familiar with at least on the charitable side, the strategies that people use. And it's, I think the important message here is the earlier you start and prepare, the easier it will be down the road. Don't put roadblocks and unnecessary roadblocks that will prevent you from using these strategies in the future.
Totally. And also, I think the other part about this is, while saving taxes is great, so there's two things, right? You ask every entrepreneur how much they sold the company for, they're going to say $100 million or whatever the number is, right? But the reality is that most of them only kept 65 of that 100 because they paid a ton of taxes on that 100. Now, sometimes that's okay, because sometimes they just want the cash. So you shouldn't really let the tax tail wag the dog of the sale, right? So like, or the owners or the sellers or the group of sellers lifestyles. Some of them want to cash out. They want all that money in the bank, and they want to go do whatever they want to do. And some of them are hyper focused on saving money on the taxes. So it really depends on the person again. But something like, I think it's something between 25 and 30% of deals have tax planning associated with them, which is a shockingly low number to someone like me, because it feels like people should be putting more emphasis on this. But a lot of them they either don't know about it, or they don't take advantage, or they don't plan appropriately. So I think you're right, like getting started early is really crucial to putting all these plans in place.
So Michael and Len, I have a question. As somebody that's been in the nonprofit industry for years, how could we target some of these companies that are thinking about donating to nonprofits? Oh, you're smiling. I like that.
I love your new business development. It's amazing. I think most of the stuff's about creating relationships, right? So like, if you go talk to an investment banker, go talk to somebody like in my seat who sells businesses. I'm not an investment banker, but I advise companies on their sales, right? It's just make that clear. But the point is, talk with some M&A attorneys. The M&A market right now is hotter than I've seen it in my 12-year career, right? So like it's extremely hot right now. There's a lot of money. And I think it's talking with those M&A attorneys, talking with those investment bankers, because they will help with, like, their deal flow is going to help you probably gain access to some of those founders. Because honestly, I talk to investment bankers and M&A attorneys every day. So I'm like, what are you doing for tax planning? Nothing. Well, are they charitably minded? Yeah, they love the whatever charity X, UCLA, like some school, whatever, some nonprofit. I'm like, so like, you don't want to get them the deduction current year when they have all this money coming in. We didn't think about that. It wasn't important to them, right? But I think if you make it known to them the opportunities that exist, especially in the next year, because of some of the CARES Act legislation, now is like the best time in the world to donate to a charity. Because the normal adjusted gross income restrictions have been lifted.
Well, I think I'll call you later.
Sounds good.
Just to hear that laugh.
That's right.
All right. Any other last questions for Michael? If not, I'm going to thank everybody for attending today. We'll see you in the new year. We have 2 programs coming up in January. One is going to be on building SaaS subscription models and how to incorporate that into your business model. And the second one is going to be on how to access markets overseas. So 2 great programs, and we'll look forward to seeing you all there. Michael, thank you once again for your time. Happy holidays to all of you. Be safe, Stay COVID-free, and look forward to seeing you in the new year.
Thanks, Len.
Bye-bye.